Welcome to the 39.6 Facebook Live show, episode number 14. This is the show that teaches you how to make your money work for you so you don't have to work for your money. In today's episode, we are going to start our week on the most boring topic, taxes.
Hey, let's get moving. Come on, and spin around with me. I love dancing. I love dancing. Dance now.
Thank you, Pinky. All right, so I've had so many people asking me questions about taxes, and we are actually still behind on our taxes and have not filed. So to methodically actually go through taxes, we need to go through some of the basic ones first. Okay, so today we are going to cover payroll tax. We're going to discuss Social Security and Medicare. Okay, those are your two payroll taxes. We are also going to discuss the difference between a flat tax and a progressive tax. Okay, and in this country, we actually kind of have both depending on what context you are looking. Okay, so first, I just want to say hi. We have a number of people here. Thank you, people, for joining. If you're there, you can hear me. Please give a thumbs up, give a wave, give a wow face, like something like that. Yes, we have not done our taxes yet. We filed our extension, okay, our multiple extensions. Kyle, welcome. Thanks for coming. I think we have David over there and Kate. Okay, so today's episode, I'm trying to fit everything in the screen, including my face. Okay, so today we're going to talk about payroll tax. We have to kind of go through payroll tax first so that because it's the easiest to learn, okay? Then we are gonna go one step more complicated as we go through more videos. So payroll tax, okay? If you have a job and you're an employee, you have a W-2 income, okay? I still remember my first paycheck. You think you're gonna get paid X amount of dollars, and you look at your check and you say, where did all the money go? Okay, well, if you're making minimum wage, all your money went to Social Security. Okay, so we're going to talk about Social Security first. It is actually the easiest tax to understand other than sales tax. We all understand sales tax. You go buy something, you pay tax on it. Although that gets complicated because in different states, they have different rates. And then in different states, they have certain things that are taxed and not taxed, like produce, etc. So many carve-outs, exceptions, and that's state to state. We're going to talk about the federal taxes, and first we'll talk about Social Security. So this is only a tax you get if you are being paid as an employee. Okay, that's what makes it part of payroll. Okay, so we are going to start out. Hello, Lynn, thank you for coming. All right, so this is going to be your income. Or this is going to be the source of income. The orange juice is going to be the money. Hello? Okay, I'm going to say hi to everybody in the middle of a segment so I don't break everything up. But this is going to be basically where the money is starting. So this is your employer. Okay, so this is your company whom you work for. Okay, and then where did my beaker go? I had a beaker right here. Oh, there's my beaker. Okay, so this right here, this beaker is going to be where you are actually receiving the money. Okay, so I'm going to take your money and let's just say you're working like minimum wage. Okay, this is your first job and you're 15 years old bussing tables and you get paid $100. So I'm going to fill up the beaker up to 100. Okay, so there you go. This is your first paycheck. This is $100. Okay, now this is basically before it comes to you, to your actual paycheck. This is everything that the pay stub shows you, but you haven't actually received it yet. You can't drink it yet. Okay, so this is that $100. Now you have to pay. We're going to start with Social Security. You have to pay Social Security. and this is taxed at 6.2%. Okay, we're just going to say 6% to make our life easier. So of this $100, we need to pull off $6 from it. So I have this syringe. This is from Shinola's Tylenol bottle. Okay, and okay, this is a 5 cc syringe, and I went a little bit higher, so we're at 6 cc's. Okay, so we're going to give 6 cc's to Social Security. Okay, fantastic. So now you're left with $94. Okay, actually, I probably filled this a little bit too high. Okay, there you go. Now you're at $94. All right, so that is the first tax you pay. It is a flat tax. Now, you don't realize this when you're an employee, okay? But the Social Security that you're paying right here, this actually is only half of the Social Security that's getting paid, okay? So there is another half of Social Security that's getting paid, and that's paid by your employer. It's not paid from your income. So I'm gonna take the 6 cc's directly out of the employer, okay? And that'll go right here. All right, so basically you have 2 different halves of Social Security. You have 6% from your own paycheck and 6% that came from the employer. They add up together to 12% of your income, or 12.4% of your income. So that's actually why most middle-class people, if they had to live off of Social Security, they actually could get by on Social Security alone, on a modest lifestyle, lower than likely when they were earning, because they're actually saving, and I say quote, saving, because it's not actually invested. It's a Ponzi scheme, okay? But it is 12%. And if everybody saved and invested 12% of their money, they're not gonna have a comfortable retirement likely, but they'll at least be able to retire, okay? But there's 2 halves of Social Security. So if you earn $100, $6 goes in here by you, and then $6 goes in by your employer. Okay, so it actually costs your employer like $106. Okay, so that is simple enough. Now, if we continue doing that, and let's pretend you earned another $100. Okay, so now we're gonna fill up another 100 into here. Okay, so now you have another 100, and then we have to give $6 from the employer, okay? And I'll give $6 from you, the employee, okay? Simple enough. So now you've earned $200, and there's $12 in each of the halves of Social Security, okay? Now, that continues, okay? Social Security is a flat tax. Okay, so that makes it very simple. It's 6% of your income. Okay, now we're going to continue doing this, and let's pretend instead of it being dollars that you're earning, instead of being like $100, let's just say that it's like, we're going to multiply 100. Okay, so it's $10,000 at a time. Okay, so I'm going to start over with the orange juice. Okay. And I'm going to empty these out. We're going to scale up by 100. Okay, we're going to go 100 times bigger. So we're going to fill up here to 100, and we're going to say, okay, that's $10,000. Okay, so you're no longer working for minimum wage, or if you did, you worked minimum wage for the entire year. Okay, but let's say you earned $10,000 in one paycheck. Okay, that's like a 1 month pay for somebody making $120,000 a year. Okay, so here you go. We still are going to take 6. Now this 6 is not $6, it is $600. Okay, and then $600 from the employer. Okay, and that $600 goes over there. Okay, fantastic. This all makes sense. It's 6%. So you earn $10,000. That's $600 to each place. So if you're earning $120,000 a year, every single month you're paying $600 or $620 to Social Security. Okay, that's actually a pretty substantial payment. If you think about what you pay for a lot of other things in your life, Okay, if you pay for rent or your cars or groceries, $600 is a lot of money. Okay, or 620. Now, if you continue doing that for a whole year, okay, so let's just pretend we just got 100. We have $10,000 in there. I'm going to fill this up all the way up to 300,000. Okay, so sorry, $30,000. So you're earning $10,000 a month. This is 3 months. So I added $20,000. So I have to add 12,000 to your side, and I have to add. Oh, took it from the wrong bucket. I need to take this part from the employer. Okay, I take $12,000 from the employer, or sorry, $600 each. $1,200 from the employer and $1,200 from the employee. Okay, so that's all fine and dandy. Every single month, you're putting $600. Okay, so I'm going to speed this up just to not belabor it, but I'm going to say that's been 3 months so far. We have $1,800 in here, $600 a month. That's March. So now I'm going to go to April. Oh, I mixed them up. April. Okay. I'm going to go to May. I'm going to go to June. July. August. September. October. November. And December. Okay, so that was 12 months of earning exactly $10,000 per month. And that's a total of $120,000. Okay, so if you had actually put in 6.2% into each of them, times $120,000, 6% times 120 is going to be 7,200. Okay, so you're going to have over $7,000 in each of these. Okay, now this is all very simple, and I'm kind of going through it slow to make it make sense. But there's something that actually happens at the end. So we got up to 120,000. If instead of earning 10,000 in the last month of the year, you actually earned 20,000. Okay, so let me give you an extra $10,000 here to your paycheck. Okay, there you go. That was $10,000. Now what's going to happen here is that now you're up to $130,000. Social Security actually stops. It caps out at an income of $128,400. Okay, so you would not actually pay 6% on the entire extra 10,000, going from 120 to 130. You'd only pay the 6% up to the first 8,400. Okay, so that would be like $500. So I'm just going to fill up the syringe to $5 or $500, and I'm going to do the same thing from the employer side. I'm out of orange juice there. Okay, so I'm going to take it just from here just to pretend. Okay, so now we're up to 130,000. Let's pretend you earned an extra $10,000 at the end of the year, stuck it in before the end of December. You got like a bonus paycheck, and you got another 10,000. Okay, well, if you actually got another $10,000, well, we get to $10,000 more in here. Okay, so I have to overflow. And guess what? We are over the Social Security limit already. We've gone from 130 to 140,000. There's no more Social Security. You are done. It caps out. Okay. So if somebody had earned, let's say, $200,000 a year, and you're earning like $16,000 a month, well, once you're in like August, you already hit the $128,000 or September. Okay. Once you hit that $128,000 limit of income, you are done paying Social Security. Okay, if you hit 128,400 in the first month of the year, you pay no more Social Security for the rest of the year. Okay, so it is a flat tax with a cap. It is the only tax that stops so that you have zero more tax the more you earn. Basically, in this country, that is the only tax that goes down on the last dollar you earn. Okay, and they charge you more on the first dollar you earn. Okay, now, Medicare. Okay. Medicare, well, actually, you know what? We're going to do this one step different. I'm going to throw one wrench into this before we talk about Medicare. Okay. And I'll take a break for a moment just to say hi. Bantu, great to see you here. Pat, thank you for coming. Lynn, thank you for coming. I see a Rachel that Kate said hello to. Welcome everybody who's here. Okay, so I'm going to throw a wrench into this now because a lot of people have access to this, okay, and that is an HSA, okay? An HSA is a health savings account, okay? And this health savings account can be utilized for health expenditures and it's paid with pre-tax money. You don't pay any tax to get money in here. You don't pay any federal tax, any state tax, any Social Security, or any Medicare, okay? So this HSA bucket is special, okay? So let's start from the beginning and remember let's say the first $200 you earned, okay? You earned $200 here, okay? And let's pretend your employer has an HSA that you're eligible for, okay? So this $200 that you've earned, remember, the employer has to pay Social Security. So your employer has to pay $12 to Social Security. So here's 6, and then I need to get another 6. Okay, so here's $12 that your employer paid to Social Security. Okay, now your income here, you have this $200. It hasn't come to you yet. You could decide to put all 200 of this into your HSA. Okay, if you do that, I have to borrow all these things from our child. Okay, $200 to your HSA. Okay, so, okay, good. So your HSA now is filled up with $200. Your money gets to go into your HSA before the government takes Social Security money from your income. So this is what we call, I call it, I don't know if it's a legal term, but I call it pre-FICA, okay? So that means it's before all of the FICA taxes, and FICA includes Medicare and Social Security, okay? So before the payroll taxes. So if I put money and divert it from my income into the HSA, I now have to pay 6% of this to the employee portion of the Social Security. Well, there's nothing in here. So 0% of 6% of this is 0. Okay. So if we do this again the next month, okay, you're not getting paid a lot here, but you have access to an HSA. You get paid another $200 the next month or the next paycheck. Let's say you get paid every 2 weeks, another $200 here. Well, you could divert this again into your HSA, okay? Because you are well under the $6,900 limit for HSAs if you're married, okay? So my HSA right now is a little full. Okay, so I'm gonna make room for the HSA. All right, here we go. There we go, room for the HSA. So look, we're back to 0 again. All right, so it's just orange juice. It is just straight up regular orange juice, okay? And then Social Security, nothing with Social Security. So your HSA bucket is very, very valuable, okay? Some of you don't have an HSA. A lot of you might have an FSA, a flexible spending account, and that's what we have, and it's very similar, okay? The limit is lower, it's $2,650 per person, Okay, so $5,300 per year, but that money that goes into a HSA or an FSA, it goes into there first. You do not pay Social Security tax on any money that goes into your HSA. Okay, so it can save you a lot of money in taxes by putting it there. Okay, so that is Social Security. In summary, it is a flat tax of 6.2%. The employer has to pay 6.2% no matter what. Okay, the employee pays 6.2% only on the amount that did not go into the HSA, okay, or FSA. Also, you actually have other pre-tax deductions like your medical insurance and dental insurance and vision insurance. All of those things are pre-FICA, okay? But on the employee side, you pay 6.2% of everything that you earned minus all of those deductions, okay? But only up to $128,400 of earnings, okay? So basically the Social Security caps out at $7,960.80 for the employer or employee, and $7,960.80 for the employer. The employer does not get to take deductions for the HSA or your insurance. They're paying that 6.2% regardless. You just don't see it, okay? Now, all right, so that is Social Security. It's a flat tax with a cap. It's the only one with a cap. As long as you're making 130 or more, you're flat at 8,000. Okay. If you are self-employed, you are paying both halves of Social Security. Okay. So you are actually paying 12.4% for Social Security. Okay. Now, we spent a lot of time on Social Security. We're going to spend less time here on Medicare. Okay. Medicare is similar but different. Okay. So we have to I'm surprised I haven't spilled anything yet. All right, I shouldn't have said that. Okay, so here again is your employer income. Okay, so your employer is going to pay you and you have to pay Medicare tax. Okay, this is a separate tax, and I don't really understand why the government has different taxes, which things get to be coded as its own tax. Why can't it all just be federal tax? But they have separate for Social Security and Medicare, and that's just how it is. Okay, so Medicare is a lot lower. It's 1.45%. Okay, 1.45%. We can round it up to 1.5%. Okay, so your employer is paying you $100. Okay. Okay, so we're going to pretend that you don't have an HSA or FSA. We're going to make this simple. Okay, so you have to pay $1.50. Okay, that's 1.5 cc's. Okay, and your employer has to pay $1.50 also. Okay, so good. That's the first $100. Very, very simple. Just like we did before with Medicare, with Social Security, but about 1/4 as much. It's a much lower tax. Okay, and what you're doing with Medicare is you're prepaying effectively your health care for when you're 65 or older. Social Security is prepaying for like your life expenses, like a retirement account would, and your Medicare prepays your medical expenses. Okay, now Medicare is different. So I gave $100 and we put in $1.45 into each of these two. Okay, if we scale it up to $1,000 of income, it'd be $14.50. $14.50. So for every $1,000 you earn at your job as a W-2 employee, you're paying about $15 to Medicare, paying about $60 to Social Security. Okay, now this continues through the whole year. If you're getting a big paycheck, remember what I did before? We did 100 times this. So if we have $10,000 per paycheck, okay, and you take that 1.5% of $10,000 is $150 to Medicare from the employee and $150 from the employer. Okay, so remember $600 to Social Security and $145 or $150 to Medicare. So for every $10,000 you earn, you're paying about $750 to Social Security and Medicare. And remember, like, think about your expenses. $750 is a lot. Okay, $750 is more than you're probably paying for your car. Okay, or maybe for groceries. It could be rent for a lot of people. Okay, that's a lot of money. Now, Medicare is not a flat tax. Okay, it's a flat tax in disguise. So let's pretend you're making a lot of money. Okay, let us pretend you are earning $25,000 per month. Okay, all right. So if you're earning $25,000 per month, and let's say you're not married, you're single. Okay, so $25,000 per month. What's going to happen is I'm going to put 25 cc's in here. Okay, so that was $25,000. You just have to think bigger. Multiply by 1,000. So $25,000 in 1 month. This is January. Okay, we have to take 1.5% of $25,000. So that's about $375. Okay, so I'm gonna just take a little bit here and then a little bit there. Okay, now that was the first month of January. $25,000 of income, $375 each to Medicare. Okay, we do the same thing for February? Now we're up to $50,000 of earnings. Okay, you're up to $50,000. We're gonna put $375 here and $375 there. In March, we're up to $75,000. Okay, $375 here and $375 there. In April, we're up to $100,000. Okay, $375 here, $375 there. Okay, now in May, we're up to $125,000. $375, $375. In June, we're up to $150,000. $375 and $375. Okay, I just got distracted, lost track. So we're doing $25,000 a year. Let's say we went through June, that's $150. We get to July, okay, we're up to $175,000 and put $375 into the 2 Medicare buckets. Okay, now in the 8th month, in August, we're up to $200,000 and we have $375 each. Okay, that's August. Once you hit $200,000 as a single person, you get the Medicare bonus, okay? And I'm gonna put this in the middle here because this bonus is paid by the employee. It is not paid by the employer, okay? So once you hit $200,000 in the next month, when you earn $25,000 in September, you still have $375 going into Medicare on the employer side. Okay, I should write from here. $375 from the employer and $375 from the employer and $375 from the employee. But this Medicare bonus is another approximately 1%. Okay, so you have to put in another $250 over here in the bonus bucket. So now instead of paying 1.45%, you're paying 2.35% once you exceed $200,000. Okay, and that was the month of September. Now in the month of October, it'll be the same thing. You have to put your $375 in here. You have to put another $250 over here, and then the employer puts $375 over there. They keep paying the same 2%, 1.45%. Okay, so that was September, October. Now in November, $375 here, $250 here, and $375 here. And then in December, the last month of the year, you get up to $300,000, $375 there, $250 there, took it from the wrong one, and then $375 over there. Okay, so that's the end of the year. So what happened is, for Medicare, you don't have a flat tax. You have what's called a progressive tax. You started off the year just paying 1.45% from the employee and 1.45% from the employer. Okay. And you continue doing that until you hit $200,000 of income as a single person. After that, you had to pay an additional tax. So it went up to 2.35%. And that continued until the end of the year. That never stops. It goes on for perpetuity. So when we talk about tax brackets, what we're really saying is what is the tax you're paying at the end of the year, the highest tax rate you pay for something. Okay, so when we say tax brackets, we're usually referring to the federal taxes, not Medicare or Social Security, but it still matters here. So basically, if you are in, if you earn over $200,000 as a single person, you are in a Medicare bracket of 2.35%. Okay, and the employer pays 1.45% with no cap. Now, remember what I said before about an HSA? Well, if you put money into an HSA, you can avoid paying money to Medicare. Okay, so that still works out the same way it did for Social Security. The employer is still going to be paying their percentage to Medicare, but any dollars that go to your HSA or your FSA are deductible, so that they do not affect what we call your Medicare taxable income. You will not pay any Medicare tax on income that got diverted into your HSA. Okay, so Medicare is a progressive tax with two brackets, 1.45% and 2.35%. Now, it is also interesting the way these two taxes work with Social Security and with Medicare. Okay, this is simplifying. I have the two of them here. These are both capped. The federal tax is either single or married filing separately. For payroll tax, it's done a little bit more on an individual basis. Social Security caps off when any one person earns $128,400. Okay, it doesn't matter if you're married. It doesn't matter if you're single. If you as an individual earn $128,400, then you're done. Now, if you happen to have two jobs and you make $128,400 at each of the two jobs, they're each going to withhold Social Security. But what happens is when you file your taxes, it's going to get corrected so that you're only paying taxes basically on one of those jobs. You only have to cap it out once. Okay. If you earned like $64,000 at one of them and $80,000 at the other, it'll get corrected. So you're still only paying the maximum, the $7,960.80. Okay. Now, Medicare is a little bit tricky because it matters. Your marginal tax rate matters if you are single or married. Okay, now I'm coughing. I'm drinking my Medicare. Okay, so here is, where's my bonus bucket? Here's my bonus bucket. Okay, so this is very confusing. So if you are single and you earn $200,000, you are only using this bucket. After $200,000, you're filling up both of these two. Okay. If you are married, it's a little bit different. They combine your two incomes and you fill up this bucket until you hit $250,000 combined. So 250, not 200. Then after 250, you start filling up this one. Okay. Now in practice, that's not what shows up on your paycheck, because on your paycheck, the withholding, they don't know if you're married and they don't know what your spouse's income is. So they don't know when you hit 250 combined. So they don't know when to add this. So they just assume you're single in general on every paycheck I've seen. They just assume you're single and they do this bucket till 200 and then they do this one after 200. When you file your taxes, it will get corrected. Okay, so that you are paying this rate with the bonus starting at 250 combined. Okay. So it might be that you're a single earner household, you earn $250,000 and they start charging you this Medicare bonus, those last $50,000 of the year. Well, because you're married and you only hit 250, you're going to get that money back when you file your return. It'll come back to you as a refund. Okay. So 2 different taxes. Social Security is a flat tax that caps off. Medicare is a progressive tax. It has 2 different brackets, 1.45 and 2.35% to the employee. The employer pays a flat 1.45% all the way through. Okay. Both of them can be reduced if you put money into your HSA or an FSA or into your medical plan or medical insurance plan at work or vision or dental, all of those pre-tax deductions. You do not have to pay Medicare or Social Security on. Okay. There's Social Security and Medicare. Okay. So those are your 3 taxes. That's the payroll tax. If you are an investor and you earn all your money outside of payroll, if you just earn it from your investments, you do not pay any of these. Okay, so these are only earned by people who are earning wages. Okay, and if you are a business owner, you are paying them. My screen just went blank. All right, so that's it for today. Taxes is a boring topic. I get a lot of questions on it though, so I'm trying to go through it slowly so I have a reference for other people to watch and understand later on. Okay, Emily, if you're still here, thank you for coming. And if there are any other questions, I'm happy to answer them. And Kate says that now that all of our orange juice has turned into taxes, I wonder if he's going to drink it or give it to, I don't know who. So, okay, that is it. That wraps it up for today. Lesson 1 on taxes. Lesson number 2, we will probably be going to state and federal taxes. We shall see. Until next time, take it away, Pinky.
It's time to
Sorry.
boogie down with beat now. It's a beat.
You gotta go louder.
Hey, let's get moving.
Oh, there we go. Thank you, Picky. Good night, everybody.